gave up managing billions to become a better investor. Episode 28. Investment is always 90% perspiration, 10% inspiration. Hello. Yes, another podcast and another mention of the 90% perspiration, 10% inspiration quote. We won't, fortunately, this time talk too much about why that's important. See previous podcasts and undoubtedly actually future ones as well. I was thinking, though, that there's actually another reason why I used it, and that's because we're at, I reckon, 90% of the way through the current corporate earnings season. Normally 6.5 weeks long. I think we've just finished week 5 of the global corporate earnings season. So, yeah, I think we're about 90% odd of the way there, which is great. Very interesting week. We'll talk about that in a couple of minutes' time. Had a bit of macro news as well to follow in the last 2-3 days. CPI numbers from the States and China were intriguing. Still seems to me as if it's pretty clear that the inflationary backdrop is improving, which is good. Actually, in China, of course, we've got the threat, the potential, the actuality, I guess you could even say, of falling inflation rates. Disinflation, deflation, however you want to call it, probably erroneously, actually. Let's call it just negative inflation. And actually, when you look at some of the other numbers, PPI numbers, for example, producer pricing numbers, that has been negative for a little while longer and is a better guide, a better insight into what's upcoming. So let's call it a dearth of inflation in China. And obviously that's intriguing for the global backdrop. I guess more important, though, for us, global stock pickers, it's not that China is having low inflation rates. The fact that the States is having lower than perhaps the Federal Reserve were even thinking about a few weeks ago when they raised interest rates again. And as I've said before, I think that was a mistake. I think I would have held interest rates. And we'll obviously see what they do at the next meeting in September. Of course, I've got the Jackson Hole Conference, which used to be such a big thing in August, but it's a bit less so nowadays. They've got the Jackson Hole Conference later on this month, but that kind of feels a bit as if it's going to be a bit dull this month, mainly because everybody knows that actually the next CPI update from the States is happening before the upcoming September Federal Reserve meeting, which again is going to be a fantastic insight into really whether the Fed should be doing nothing or not from their perspective. And my observation generally is that inflationary aspects are loosening. They're getting lower for all the reasons we've talked about before. The reality that the cost of living crisis, if you want to call it that, in almost every country in the world inevitably is meaning less demand, more supply. And particularly back to sort of basic economics and the like, no great surprise that inflationary aspects are getting better. UK perspectives, obviously we've had some interesting updates on the inflationary backdrop. We've talked about these over recent weeks. I guess the most interesting insight in the last few days were Friday's announcement about GDP progress, which on a quarter-on-quarter purpose was up 0.2%, which I guess was a little bit better than the flattish sort of indication that people were thinking about. Is this a sort of a miraculous insight that the UK economy is not only seeing a reduction in inflation from a few months ago, but also a remarkable improvement in growth? Well, unfortunately, not really. We're seeing the lower inflation for all the reasons we've talked about already. Less demand, more supply and related matters, easy comps and the like. But the growth numbers remain mixed, to say the least. And unfortunately, when you put all of that together, I would still say the Bank of England were wrong to raise interest rates early this month. I would have, as I said for the Federal Reserve a couple of minutes ago, I would have held interest rates. And we'll see what they say at the next meeting, again in sort of 5-6 weeks' time. So lots to the macro perspective to think about. And it's not just about inflation, is it? I mean, the last week has seen some, again, difficult, horrible, negative, poor insights from matters around weather, impact on economies, impact on people's holidays, strikes, uncertainties like that, what are food prices doing, and related matters. It's not an impossible world. I keep on saying this. It's certainly not. And we'll come to corporate earnings season in a minute, which again, I think indicates it's certainly not an impossible world. It's just a tricky-ish backdrop. And whilst it's kind of if you like, positive to see the fact that the inflationary backdrop is improving. It's getting better, i.e. lower. Nevertheless, the general economic backdrop that I observe is that, again, I've said this many times before, the 2010s were an anomaly. The 2020s remind me so much more of other decades that I've been an active investment watcher in, which would include, yes, the 1980s, 1990s, early part of this century and related. And I don't find that from a macro perspective, that backdrop to be impossible. It's just more tricky. And this is where it gets most interesting for investors, really. And this is where the corporate earnings season insights are how any investor should really be thinking about stuff. Whilst the macro matters, they hit the headlines, when we see, people are worried about this or that, geopolitical, food, weather matters, heat, strikes, more taxes, more debt, whatever. You've got to also then link it in with the sort of the micro matters, the qualitative insights from the corporate earnings season too. It's not just our companies beating or missing numbers, as we talked about in a previous podcast. Unsurprisingly, once again, US Inc. is beating expectations, but that's often because they've kind of lowered them in the run-up to earnings season, etc. More interesting, frankly, this earnings season has been the sensible, good, relatively attractive beating of numbers in Europe and particularly Japan versus expectations, which I think reflects a little bit that going again into this corporate earnings season, it was certainly the case during the first quarter of this year. We obviously entered 2023 in a, oh my goodness, recessions are coming. We've got some difficult things, very difficult things happening geopolitically. Therefore, it's going to be ultra tricky and you've got to be cautious. And I entered this year with a slightly more, in my normal fashion, glass half full sort of perspective. I saw plenty of opportunities for particularly equity shareholders. And I guess it's sort of happened, hasn't it? And I still see scope out there. And certainly when I look at the corporate earnings season, I'm, as always, finding not just more opportunities and threats, but plenty of things to be positive, actively attracted to. But then again, for me, it is an active investment mode. It's not one for going back and saying, just have a bit of investment exposure. That's going to be fine and it will take care of itself. And I guess with smart fund managers and the like, maybe it will. But the sort of the cheap passive approach, I think is tricky for the 2020s. I think that's patently obvious to me. We shall see. Anyway, I'm going to do probably a podcast in about a week or so's time when we kind of reach the end of the corporate earnings season for some insights on which sectors have been kind of performing best. Where should we kind of, when we bring together macro and micro stock and sector insights, what can we kind of conclude? What are we thinking about for the rest of this year, the last 4 months of this year, maybe even into 2024 and the like? More on that in a week or so, I think, when we've got sort of towards nearer the end of the corporate earnings season. Since my last podcast, 4 companies have said matters which kind of interest me, particularly in the large cap and related area as a global investor. Kind of interesting, again, to mention Novo Nordisk. I mentioned them on my last podcast, and as I sort of indicated, I have been a fan. Fortunately for me, positively, not a user of either diabetes or obesity matters, but many people sadly are. And hence the relevance, the importance of a company like Novo Nordisk has been attractive as an investor for many years. And judging by the updates that we talked about in the last podcast, the positive, particularly obesity progress they've made to supplement the diabetes, a very strong positioning, has made people very attractive. It's had another good week as a share. Interestingly, the company's shares did not positively react actually to the formal corporate Q2 update, which occurred on Thursday, mainly because pretty much all the important stuff had been said already on the Tuesday, particularly with relation to the expansion and scope for the obesity products. Is Novo Nordisk still a great medium-term core pension fund sort of holding? Yes, I would say it is. Is it, though, a company where I could see that there's a rationale? If you've been a holder for a number of years, as I have, would it be wise to take some profits? And the answer is yes, on that front. And I say that not because it's not attractive that there's not only sadly well over 500 million people globally who will be diabetes users. Novo Nordisk will be the leader there, not the only company in the sector, but an important player there. Not only that obesity matters, which again are not only being developed by Novo Nordisk. We talked about Eli Lilly on the last conference call, who again have made progress on that front too. But nevertheless, the 750,000 million apparently people who potentially could be future users of obesity related matters. Clearly, the scope for Novo Nordisk to enhance profitability, valuation, and the like is still there. But I find it interesting that the company is now the number 2 pan-European company by market cap terms. The number 1, as I'm sure many of you would guess, is LVMH. Again, very good company. Can't say I'm a big user of that company either, personally, but I do value the company. However, a company share which I don't own at the moment, and frankly, my potential buying price is a little bit lower, notably lower than today's current share price at LVMH. I'd say for Novo Nordisk, the gap is tighter, but for me, I'm coming from a different perspective. Had a good position for a while, been fortunate with the performance. Is it time to take a few profits? I think so. I think it is. And it's not one for saying, right, we're out. It's absolutely fine to take some profits and keep on holding as a medium-term player. And I'm not a day trader, but I'm not an ultra sort of, you must hold the same shares for the next 2 decades or something. I guess it theoretically could happen. But for me, the sort of the 6 to 18 month period has always been my favored time zone, just because you move from that point where a company is perhaps undervalued because you've observed something, you've seen some macro micro insights, some corporate earnings season insights, I've seen on a number of companies over recent weeks, and you're looking for that attractive price to make it a must buy. And that's worked out for you over that next 6 to 18 month period. And it's absolutely fine to take a few profits a bit early. It doesn't hurt. If you still see an attractive medium-term story, run the remainder. You've taken some profits, you've taken out, you're not going to lose money on the share in all likelihood overall, and run the rest. And I talked in a very early podcast about how my best winner of all time, proportionately, was back during the somewhat earlier time in my investing career, when I did something quite similar it was during the early dot-com boom, and you can imagine all sorts of strangeness happened there. But a company where the shares doubled, I took up my base capital and ran the rest, and it ended up going up 30%. But hey, if only all shares could work like that. I guess what I'm trying to say, Novo Nordisk, love the company, profile is fantastic. Update on Thursday was good. The update on Tuesday over the week just finished was absolutely fantastic. Is the share fully valued? Yeah. Shorter term, yes. Does it have medium term potential? Absolutely. However, should it be wise, perhaps if you've now got a somewhat bigger position because of appreciation, to take a few profits? Absolutely. Something I'll be doing myself, for full disclosure, over probably the next few days. 2 other companies which I don't own, but I've been monitoring. I think they're quite popular amongst global investors. One is Siemens, a German company, nicely diversified, probably a little bit more focused now than it would be. Certainly, I remember meeting in a completely different story. I'm not sure I've made this disclosure before. Nothing strange about it, but just quite funny, really. I once went to a conference, and I was listening to the Siemens quarterly presentation in London, and I needed to go to the toilet before the presentation started. I popped in there, and who walked in just behind me was the Siemens CEO. I was a little bit younger, not confident enough quite to sort of say hi, good luck with the presentation or something like that, which I probably should have done, but just nodded to him, etc., and went to wash my hands or something. But there you go, it always makes you smile. Not the current CEO, my goodness, this must be 2 or 3 CEOs ago now. Shows how many years ago it was. But anyway, but interesting. Siemens has been actually quite a successful company for me at various points over my institutional investing career. I made a small error 6-12 months ago. I should have probably bought the share back then And I didn't, mainly because there are slightly more, at least from my perspective, more attractive opportunities back at those points, but actually would have worked out well. When I reran the numbers, looked at the company with their update a few days ago, I thought actually, yeah, it's gone from being cheap to being sort of fairish value. And I talked about in a previous podcast earlier this week that actually if I had to choose a German listed company, which I thought was particularly interesting, it would be Bayer, depending how you want to pronounce the name. I always say Bayer, but apparently Bayer is the more correct term. I'm happy to be discussed on that front. My pronunciation is horrible at all levels. But anyway, as I talked about in the previous podcast plus one, it's a really interesting company to look at. Siemens, by contrast, I think is a good company. Shares are not quite attractive enough for me. But again, as always with corporate earnings season, lots of new insights, good insights, useful insights from a general application point of view. Ditto, actually, the third company I was going to mention briefly, which was the observation from Disney. Now, Disney, again, it's not a company that I'm a regular either user or owner of. I don't subscribe to any Disney Plus sort of online opportunities. Not a particular Disney film viewer, and whilst I have been to a Disney park before, it was quite a few years ago. I don't expect myself and my family to be going there at any point in the near term. But there you go. Who knows? Anything's possible, I guess. Disney shares. They were intriguing, actually. I do think the share is cheap. Is it mega cheap? Probably not. Fair value, I kind of keep on coming out, and this is actually true now for about the third quarter in a row. So either I'm doing something right or wrong here. But my perspective is that's about the fair value for the share. The share, if I recall at the moment, is sort of 90-ish and change dollars, so therefore undervalued, attractive. If you're looking for an S&P 500 company, I guess you could do worse. Is there uncertainty in the space? Of course there's uncertainty. It's kind of interesting, isn't it, how I'm less worried about the parks business. I think Disney Plus, the higher pricing, the getting their heads around how to operate such a business is working, broadly speaking. The film franchise is good, and I think their understanding is that you've got to probably do some of the cinema and some online, Live and Unleashed and related, and that's kind of working okay. And ultimately, I think Disney will become a smaller business. I think some of the sports, news and related aspects, we're either going to have to push them overtly as part of their online offering. Really, by overtly, I mean everything is paid for on the Disney Plus offering, and you don't have your sort of your how do the Americans call it, kind of your TV link, etc., as perhaps is paid for at the moment. We shall see on that front. But I think Disney is a cheap stock. Am I quite confident enough to buy at the moment? No, I probably again still got too many other stocks that I found which I'm a bit more interested in. But if you're a holder, I would continue holding on, really, because I think the shares are a bit cheap. But there you go. We'll come back on Disney another time, maybe if something miraculous different happens. More interesting, though, is a company I do own. Again, full disclosure, I've owned for a while. I've actually bought it further twice over recent months, over the last various points of the last 5-6 months, and that's Alibaba, which you can buy if you like now, I guess the main listing, which would be on the Hong Kong market, Hang Seng, or you could of course buy them in the States as well. And Alibaba is a really interesting company. I mean, it's obviously a company well known. I don't need to explain to you how and why Alibaba, with its sort of, I don't know, Amazon-esque, Microsoft-esque, PayPal-esque sort of angles to it. Highly diversified, but I think by far and away the most interesting shift over the last, let's call it 6-9 months in Alibaba has been not just the way the Chinese economy is reopened, because frankly Alibaba is largely, I say largely, it's not exclusively Chinese focused. largely China focused, and hence the China restrictions, matters associated with COVID, lockdowns and related, actually was probably more of a winner than a loser for Alibaba. You're probably asking them, so why have Alibaba shares not been racing ahead over the sort of the deep COVID period and related? And of course, the main reason is that, and this is where, again, a bit of macro analysis becomes important, maybe a little bit more important in the average Chinese company than perhaps the average American or European company. But hey, nothing exists in a vacuum, as we talked about before. The thing about Alibaba is common prosperity. Xi Jinping's kind of utilization of that phrase, what is it now? Getting on for 2 years ago now, I think is still very relevant. And it's kind of driven how Alibaba and a bunch of, actually had fascinating listen to some of the Chinese telecoms companies over the last week as well, who actually have been more beneficiaries, if you like, of that period, of that sort of backdrop than perhaps the Alibabas and related have been. But nevertheless, common prosperity, the drive of sort of making sure that there's value for money for all, 1 billion plus Chinese individuals across all parts of the country, or different tier cities and the like. And Alibaba have made a big sort of play of this. And obviously there's a few trade-offs in terms of pricing, in terms of costs and related, which have been apparent. And I guess if you mix in a little bit of US angst and related, you'll say, while holding on to Alibaba, the game's changed a little bit. Competition, global geopolitical angst, anything could happen. Chinese government could do something unattractive to Alibaba's prospects and profitability and related. And a few people have decided to sell out. Kind of interesting that it's been at exactly the same time that Alibaba has been buying back its shares or more of its shares. It's fortunate that it has a very good balance sheet. It's fortunate that it has strong free cash flow. And I think was quite comfortable when they announced 6 odd months ago, just over 6 months ago, that the kind of split of the company was going to occur, and actually it will become 6 different companies. And we're still at that stage where those splits are becoming kind of more apparent. They haven't occurred yet, but the company's being run on a day-to-day basis a lot more as 6 different underlying zones, which is currently reporting as a single overall zone. And I thought the conference call on Thursday in the week just finishing was very helpful in that sense. It talked a lot more about those matters in a lot more detailed fashion. I found it very useful and kind of interesting to see, of course, the certain part of the businesses are doing fantastically and are super relevant, others less so. And as always, and I've done appraisals on, my goodness, now quite a few different splits, and to me it's unsurprising that whilst there are a bit of M&A activity out there always is, there's also a lot of split activity where bigger companies are becoming a bit more diversified, but splitting one company off for one reason or another. We talked about this actually with context of the pharma sector and how I've observed, be it the GSKs in the last year or so, progression at the some of the Swiss names, for example, some of the American names, so with Johnson & Johnson, with Novartis. I think we're seeing it progressively in consumer. I think companies such as, over time, but potentially a Diageo, certainly a Unilever, progressively, I think decisions by Nestle as well could occur, which is all exciting stuff and very relevant stuff. I know big companies are fantastic, and the bigger the company, the more profile it has and the like, all absolutely true. But there comes a point where it gets too big, and whilst the sort of the diversification that you can sometimes get is sort of this massive company with many different angles becomes a little bit difficult to manage and related. And I kind of feel that Alibaba was getting to that point where actually it's a cheap company, in my opinion. When I run the numbers, when you compare it to sort of some of the broad peers, the sort of some of the US tech names, as aforementioned, and the like, it feels cheap. And even when you apply the sort of the geopolitical backdrop concerns and related, it still feels cheap. And for my analysis, I'm still getting, actually, when I reran the analysis after the numbers on Thursday, I slightly upped my level to, I think it was $129 or Hong Kong dollars, as you wish, from sort of 120 odd. And that's because the numbers were good, free cash flow was great. I like the fact that the diversification, that the split angle had made good progress. And I'm comfortable with the fact that some parts of the business, if you like, some of the bits which are sort of Disney Plus-esque in a way, for Alibaba are still loss-making. I'm comfortable with that. Frankly, the international part of the business is still loss-making, not as relevant as the Chinese part of the business, not as relevant as the part I think probably the most underestimated, which should be the cloud business, where again China's actually a little bit behind the States on cloud matters. And certainly when I look at the cloud business, if you look globally, you say who are the top cloud companies in the world, it will say Amazon, it will say Microsoft, and it will say Alphabet. But actually number 4 is Alibaba. And what's interesting, of course, is that the first 3 names are largely developed market centered. By contrast, in China, the Alibabas and certain other names in the Chinese sector are the key players there. Unsurprisingly, again, if you've ever tried to use, as I have done, my Microsoft computers work okay in China, but unfortunately, whenever I use my Chromebook, which I tend to be a bit of a Chromebook user, the Alphabet computer capability user, that's a bit trickier when you go to places like China. But anyway, that's another story. All I do observe, though, is generally Alibaba is a share which, as I've owned, I've bought more shares of twice now in the last 5-6 months. I feel really quite comfortable with it, actually, and I slightly up my target. And despite, yes, you've got to appreciate a little bit of geopolitical angst, pretty comfortable. And I like this. I'm always been a bit of a fan of splits, because whenever you get a split, you tend to get an opportunity there. And it might be that one part is overloved and another part is underloved. Or, kind of interesting how, let's say, for example, the GSK split, which occurred about a year ago, just over a year ago now. In the end, you ended up with some GSK shares, you ended up with a few Haleon shares. And in the end, ultimately, and I have sold my Haleon shares, actually, that always was the pit I thought I would sell very quickly, because generally the more consumer goods centered part versus the slightly more sort of pharmaceutical part, if you want to sort of simplify it horribly that way. Generally, the consumer goods aspect would be the one which would be highly loved very quickly. But actually, it took a little bit of time for that to come. Actually, had a great buying opportunity for Haleon shares, which I got very excited about, sort of various points later last year. But in the end, we got back to my target price, and I've exited, and certainly not interested in buying any more Haleon shares or buying back into Haleon shares at the moment. By contrast, GSK, I talked about GSK briefly on a previous podcast a few weeks ago. Again, nice set of corporate earnings season numbers from the company a couple of weeks ago. Still one I regard as cheap. But splits are interesting things, and as investors, good things to look for opportunities from. So as I say, whilst it would be nice to say, yes, I'm going to spot a company which is going to be taken over at a 40% discount, woohoo, that's fantastic. And sometimes it happens, believe me. I wouldn't take £1 for every time you're hoping for it, because if you pay £1 for that, you'll end up paying a lot of money without getting much back. But splits and the occasional bit of fortunate or anticipated M&A activity, that's an interesting thing for an active investor to think about. So long story to say, Alibaba shares look interesting to me still. So we shall see. What's coming up in the next week? Well, we're on sort of week 6 of the corporate earnings season, which remains, as I've said, kind of interesting. Going to be a few sorts to talk about there, but probably on the next podcast, I'll probably talk about the BRICS meeting, which is occurring on Tuesday next week. And this is where the world of macro, bit of geopolitics and the like come in. What's going to happen in the meeting in South Africa? Going to be very interesting. Always intrigued to hear what the aforementioned Chinese government, governments of India, obviously South Africa by definition, but also Brazil and Russia as well. But what they're thinking. But the thing is, the BRICS, as I've talked about before, and as you know, I'm a big fan of global exposure. I think one of the great positives, speaking as a British citizen, speaking as somebody with a good amount of British listed FTSE 350 corporate holdings, what I like about them is that they're very global. And we've talked about a number of stocks in previous podcasts where the global orientation is the key, because that's where you've got not just the population growth, but the future, even more important for an investor, the future profitability, movement and expansion and scope. It's not to say that the developed world everything's over. It's not. It's just at a different point. Wholly successful still in many areas, and frankly, with aging populations, you get plenty of success and opportunity too. Hey, come back to the Novo Nordisk example, which we talked about at length earlier, as a good indicator of that. Saying that, of course, Novo Nordisk themselves are global players, and they will see opportunities way beyond just the developed market world as they currently do at this moment in time. But anyway, the BRICS meet, I think, will be kind of interesting. And I think that would be a good matter to sort of have a think about, see what's being said. And of course, BRICS I think BRICS itself is a limited term. I think, frankly, the world's developing markets is a far better way to think about it. And I'll be interested to see who else is turning up at the meeting. That would be intriguing to see. So we shall see on that front, but I'll come back on probably Tuesday with some sort of early thoughts on that and comments being made. All I do know is that life remains interesting. The investment world certainly remains interesting. And yeah, you've heard me say it before, the glass is most certainly half full. It's rarely half empty. At the moment, it's clearly half full. And there are opportunities to find. So on that positive ending, not to say there can't be volatility in August or any other month, as we've talked about before. What is it? Stocks go up, chance of going up on a single day basis, 50.5%, hence going down is 49.5%. But as you've already worked out, I'm not a day trader. I'm interested in the medium term. I'm interested in how matters are developing at a macro and a micro sector stock basis. And frankly, a bit of short-term volatility. That's probably more opportunity than threat. Key is, though, as always, 90% perspiration, 10% inspiration. That's a better way to ultimately think about it. So on that positive basis, I'll say thanks very much for listening. Hope that was interesting, and speak to you soon. Bye-bye.